Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. Now, a lot of you, or in fact, all of you, whenever you see this, right now, live or later on, would have come across this subject of how the GDP growth is looking so pathetic, and yet the markets are doing so well. I heard it on a family webinar yesterday as well, when people were asking me as to why is this happening. Now, the question is, for when these conversations happen with me, people's money is invested are not with me, and therefore I can give them whatever answer I deem fit and come out smelling like roses. I guess our guest on the show today can't afford to do that, because people invest large real sums of money with wealth advisors, and when you are amongst the largest wealth advisors, it does make a difference. So let's get in Somnath Mukherjee to join in and talk about that and a lot of other factors on today's talking point. Somnath, good having you. Hope all is safe.
Good to all good. Hope everything okay with you. Good to be on the show.
Thank you so much, Somnath. So let's start off with that premise, right, Somnath, because that kind
Sure.
of lays out what the equity markets could do over the medium term as
Right.
well. What are your
Right.
thoughts here?
Um, the it is an interesting conversation always to have. GDP and the massive jaws, as we call it, between GDP growth and equity market performance, not just in India but globally, and it makes for interesting conversations. But um, the curious fact is that the correlation between GDP and equity market performance globally has always been very weak. It has not been as linear and cookie cutter as some of the conversations would seem to suggest. Um, the, the same for India was actually a bit higher in the past. But in India too, over the last 15, 18 years, the correlation has been steadily coming off to the extent that now in the last 6 or 7 years, the correlations are almost statistically negligible. And you can see that on your screen. The numbers have actually been coming down, which is that there is very little correlation between the fate of the macro and the fate of the equity markets. And the reason for that is very simple. The reason for that is that stocks get priced not on account of macro being great. Stocks get priced when they generate very high returns on equity, and not just returns on equity but also returns on reinvested capital. So the surpluses that businesses are generating, are they able to redeploy that in their own business at a rate that is higher than what the investor himself would be able to do? um, Combine the two, and the point on the macro becomes a little bit moot, because when do businesses generate very high returns on equity? It is when businesses are oligopolies, ideally monopolies. It's oligopolies and monopolies that generate the maximum returns on equity. So even in an economy that is not doing too well, that actually provides a fairly reasonable green field for oligopolies and monopolies to come up, and those then have very very high returns on equity, which get rewarded in the stock market. So it is a little bit counterintuitive, but if you skin the cat a little bit to level 2, you would find that it is not as counterintuitive as it seems in first instance.
No, maybe it's logical, right? I mean, there was this wonderful article that I read and something that I tweeted out as well, as to why do people look at the stock market levels as a barometer, so to say, of what the underlying GDP growth is going to be, because they could be pricing in multiple things. My question is, Somnath, and there's a wonderful point that you told me yesterday, maybe repeating it as well, is that if you want to look at macros, maybe you should trade fixed income. If you
Absolutely.
want to trade
Absolutely.
equities, try and look at other factors. Can you elaborate a bit on
Absolutely,
that?
absolutely. So, from a macro perspective, what determines fixed income investing are essentially 2 points. One is the sovereign yield curve, and the second is the credit spread. Both are intimately and intricately linked to the macro and the state of the macro. A weak macro portends to two things. One, interest rate should be soft and declining, and second, term spreads on rates should ideally be, from a policymaker's selfish perspective, be also compressing. On the other hand, credit pricing in a weak macro is always something that one needs to be cynical and a little bit skeptical about. So when you're investing in fixed income, you have to look at macros very, very carefully. Remember, fixed income is essentially, as I mentioned, two variables: rates and spreads, credit spreads, and both are macro driven. So if you're looking at investing in equities, though, the equation changes drastically. In equities, you are really looking at the residual surplus capital left after the debt holders have been paid out. And there, the choices are wider in terms of sheer market, the marketplace itself. But at the same time, you are really looking for those few companies that manage to generate a lot of residual surpluses in the enterprise after paying off all the creditors, and that number is not a very big number. In fact, if you look at the data over the last few years, about 20-25 companies in India generate about 70 odd percent of total corporate profits in corporate India. If you thought that this was very typical of India, it isn't so. It is very similar in several countries in the world, including in the US, where about 30-35 companies contribute probably 60 to 70% of the profits of corporate America as well. Um, so in the equity side, what needs to be delved into are the micros. Equity investment is all about micros, but fixed income is all about macros. It's all about how the shape of the curve will be, what direction the rates will take, and what is the view on overall credit spreads, and especially the health of the broader segment of enterprises, and whether that spread is getting priced efficiently.
Okay, let me try and ask you a slightly a tricky one. Not a tricky one, really, but we've seen the first instance yesterday of
Mhm.
a bit of a pullback. Now, the beauty is, Somnath, I was just looking at data, right? We had maybe a similar thing happening in June, wherein the S&P 500 dropped 6%. Since then, we rallied about 15%, even
Right.
after yesterday's fall. My question to you is, when everybody's talking about the big getting bigger and getting priced obnoxiously, was yesterday the first of the corrective moves? Is it possible to predict that? And if you don't think that is the case, do you reckon that this phenomenon of the big getting bigger and more money chasing those companies will continue, not only world over, but also in India from here on?
Right. So two things. Can we predict every move like the one that we saw
No.
yesterday? No, unless we are grade A astrologers and you believe in astrology. Can this happen again? Absolutely. That's the nature of the market. The reason why equity markets afford supernormal returns 6-7% over the risk free is because you are willing to take that risk. Um, but at the same time, the latter part of your question, which is on whether the trend of money chasing a few companies will continue, we think that it's a structural trend. Now, whether big getting bigger or some of the newer businesses that are getting created globally in several parts, whether it is electric vehicles, whether it is fintech, or many others where the existing incumbents may not be all that big, but certainly money chasing companies that are quality and hence generating superior returns on equity, that trend will continue. And we expect that to be the case in the next few years.
Interesting. So, what is it that you are doing at ASK currently when clients come and tell you that, okay, I
Right.
have, let's say, 5 crore rupees to invest into. Right now,
Hmm.
I'm giving you a fresh check. What is the
Hmm.
allocation currently with versus equities versus debt,
Right.
local versus global equities? I don't know if you
Right.
do that, but if you do
Sure.
that, and then
Yep.
other avenues as well. Can you give us a
Right.
brief idea?
Right. So obviously, asset allocations are very client dependent, depends on risk profile and objectives and so on and so forth. But broadly, the way we are looking at markets is that when you are investing in fixed income, stay exclusively and almost zealously with the sovereign and the true AAA end of the spectrum. We are not given the weak macros, and we think that India's macros are going to remain challenged in the next 1 to 3 years, while we sort of find out an equilibrium level of growth for ourselves. In this kind of a scenario, credit is not priced very efficiently in India in best of times, and this is actually not a great time to be in credit. So it is extremely important for investors to therefore concentrate fixed income investments purely towards the sovereign AAA end of the curve. Um, Not least because there is an enormous amount of value in the curve. Indian rates, especially in the medium and longer end of the tenor, still offer significantly higher carry than most other countries. Our term spreads are very high. In fact, I don't remember the last time the term spreads were this high, probably 16, 17 years back, which is the difference between the 10-year and the repo, or any other long-term to short-term spread that you want to take as a benchmark. So with all the disruption happening all around, it just makes for an excellent investment case to simply be take the essentially take the credit out of the equation and simply be in the sovereign and the AAA end of the spectrum on fixed income investing, and that should be pretty rewarding for investors in the next 2 to 3 years. On the equities,
Sorry,
sorry,
sorry. Can I just come in? Can I just
sure.
come in here? Now, that's the. I mean, it is. I'm just saying, for an investor's perspective, he would say that ये तो मुझे भी पता है, right? I mean, why do I need to come to an expert wealth advisor if he's
Mhm.
asking me to invest with the sovereign, which is the lowest return possible in the credit space? So then I mean, how does it all tally up then? How does it
No,
add up?
right. That's a that's a good question. However, it isn't about just the lowest return. It is also about which end of the rate spectrum do you park
Okay,
yourself in. Really, there is a hypothesis that you don't really need a wealth manager if the neighborhood State Bank of India branch was giving a fixed deposit for 8%. The reality of the situation is that the neighborhood SBI branch has stopped giving a fixed deposit at 8% for a very long time.
right.
Given that you still need to make a reasonable amount of returns out of your fixed income investment, certainly it's something that kind of beats inflation by, say, 100 basis points. You still need somebody to navigate your way through
Sure.
the space, because fixed income prima facie looks a little simple, but actually, in terms of investing, whether you need to be in the longer end of the curve, whether you need to choose between GSECs and STLs, for example, whether you need to choose between certain types of AAAs and avoid the others. Remember, ILNFS was a AAA as well, and so on. There is a very, very strong case for being careful with it and calibrated with it. If you are too conservative, you miss out and finally get suboptimal, below inflation returns. For example, buy and hold a 2-year bond today will and sticking to the whole GSEC sovereign AAA philosophy will barely get you 4.5, 5% returns in the next 3 years. If that is what you're looking for, just go to the neighborhood branch and
Sure.
pluck pluck out the best bank that's giving you a fixed deposit for 2 years. But if you are looking for something more, then you need to see which end of the curve, which instrument, which types of strategies will play out in this kind of a situation.
Yeah.
I think there is some value that is
No,
still
no,
to be added
no,
in
not
that
at all.
sense.
No, no. I was just wondering
Yeah.
as to why is it that you guys are thinking that
Hmm.
that the sovereign is the best thing and maybe not some of the others.
No, the
That
reason
was the
why,
reason.
yeah. So the reason why we think that the sovereign is the best risk-adjusted option currently is simply the two facts that I mentioned. Number one is that
Macros.
with a weak macro, the credit environment is not very good,
Yeah.
and in India, best of times, credit is not priced very efficiently. And number two is that in the medium to longer end of the curve, the sovereign itself is offering very good carry.
Got it.
And we are expecting with spreads to compress, which is the term spreads to compress, there is good opportunities for capital gains on that side.
Yeah.
So that is the
No,
whole investment rationale.
point well taken. And viewers, remember, at times it's better if you are told that, hey, the returns may be only X and not X plus Y, but it is still the better instrument to invest in. Because a lot of times, all of us get carried away if the returns are even marginally higher, but kind of don't look at the disproportionate risk that you might be taking. And it's not
Yep.
difficult to identify that. Now, just a follow up and then a two-part question, Somnath. So, therefore, what roughly, I mean, I know it could be client specific, but on average, what's the quantum of portfolio that you are recommending in fixed income versus equities versus others? And then, of course, I would love to have your view on how much allocation are you doing to Indian equities currently in
Right.
an average
Um,
client's portfolio?
so, from an Indian equities, from an equity standpoint, um, there is a case for not staying out of the market. One of the curious things and interesting things about the current market rally has been the amount of hate that the rally has engendered. It has
Yeah,
been perhaps the most hated market rally that I have seen in the last 17, 18 years, wherein investors have simply stayed out, hoping that there will be a crash, and that hasn't happened yet. And in the meanwhile, they have lost out on significant amount of run up in the markets that have happened. So we don't think that this is a situation where people should stay out of the market. Incremental calls on whether to book profits or to make an incremental entry is often determined by the state of the current allocations themselves. But one of the things that we have been in fact advising very strongly to investors about has been to have meaningful allocations to non-Indian equities. Indian equities are a great opportunity, have been a good wealth creator over the last several decades, but by no means is it the only game in town. By no means is the Indian economy the only economy where opportunities are coming up, where newer ideas are getting germinated. There are several countries, whether it is the United States, parts of Asia, parts of Europe, where there are interesting companies coming up, and people are making a tremendous amount of wealth is being created by taking exposure to them. Um, Given the constraints of investing offshore, depending on again how much money you have offshore, because perhaps you're a non-resident, or maybe parts of the family is non-resident, or you might have some money or capital that you have sent over the years through the liberalized remittance window, or via the domestic feeder fund products. Uh, it is quite important to start building a meaningful allocation to non-Indian equities. Starting with creating a base, creating a core portfolio of U.S. equities. U.S. Represents the deepest, largest, most sophisticated, and certainly one of the most interesting markets in the world. The best companies in the world, even if they are not domiciled originally in the US, tend to come and get themselves listed in the US. Cognizant Technologies, second largest IT company in India, is not listed in India; it's listed in the US. There are many such examples, and
yeah.
hence it is just a slam dunk for people to create a core portfolio of US equities. That's something that we've been talking about with our investors for a very long time now.
So can I just ask you? I mean, roughly,
Mhm.
I don't know if I missed it, but if I'm investing 100 rupees with you,
Mhm.
what is the percentage of that is in the sovereign fixed income? Average client, what is in Indian equities? What is in
Right.
global equities? And then any other asset classes that you might
If
be
if this
esoteric as they may be.
Right. If this was a completely greenfield portfolio that was being created for
Yes,
someone
yes.
of your age bracket, I would say about 35-40% in fixed income, 35-40% in Indian equities, 10 to 15% in offshore equities, and the balance keep a little bit for a range of alternative products that may suit you. Whether it is private equity, whether it is long short, whether it is investing in early stage ventures. So the balance kind of 10% odd in those alternatives. So that would be a balanced sort of portfolio for someone making a greenfield investment.
Okay, I'm presuming when you're saying somebody my age, you're presuming my age to be much lower than what it is. But anyways,
We'll keep that.
yeah, for an
Keep that
off-air
a secret.
conversation. Yeah, just one quick thing, Somnath, and that is on. Uh, I'm guessing the influx of large HNI money into wealth has been going on. I think
Right.
the most recent change in India, albeit maybe in the US as well with Robinhood traders, but in India for sure was the influx of the retail traders. Right, in June we did a story about how trading on the cell phone
Absolutely.
was higher than trading on the normal platform ever. So, what do you think this is an indication of? Because most people tell me that,
Hmm.
boss, if retail is participating, then we know how this ends and it ends badly.
Um, I don't, I don't subscribe to that theory. I'll tell you why. Because
Super.
uh, for the longest time, we have heard that the so-called smart money is smart, and retail and individuals are, by derivation, I guess, dumb. The opposite of smart is dumb. But it's not as if that the so-called smart money has always made money, right? If that was the case, then we wouldn't have so many institutional investors, struggling to beat the benchmarks, and that number is not a small number if you start delving into the numbers per se. So I would say that instead of looking at the current market rally and the retail participation there, trend back about 4 or 5 years. Yeah, the chart here, of course, shows enormous spike in April, May, when the lockdown happened, and the participation just went through the roof. But this is actually a second order impact of a trend that probably started 5 or 6 years back via mutual fund SIPs. You look at the flows from mutual fund SIPs into equity mutual funds. Today, average monthly flows, which is essentially predominantly retail, into equity mutual funds via SIPs, is anywhere between 6 and 8,000 crores a month. Now that was the real retail move towards equity. I know that the mutual fund industry gets a lot of flack for several reasons, some right, some not so right. But one of the things that it should be given credit for is the enormous expansion of participation as well as absorption of equity culture within the retail segment through the SIP route. So, with so many investors, a very large base of investors who now have experience of equity markets by having invested via mutual funds in equities, and many of them have probably good experiences to tell about this. Certainly, those who started probably 7, 8, 9 years back have great experiences in terms of the returns that they've made in their portfolios. Now, those investors today feel confident enough to come into the stock markets directly and dip their toes. So, this is not a case anymore of people simply giving in to their FOMO, the fear of missing out kind of thing, and listen, somebody has made 3x in two weeks in a particular stock, so let me also try my hands at it. This is a more structural trend. The SIP volumes have remained remarkably stable through several market volatile events, whether it is the current one or any of the uh, periods that we have seen in the last 7 or 8 years when markets have been choppy. Mutual fund SIP flows have been remarkably stable, and that has led to a class of investors that is used to volatility, that is comfortable with it, and that also seeks to profit from it. And obviously, the general demographics of India in the younger population, people who are comfortable with the cell phone, a tremendous amount of disruption in the intermediation market as well, in terms of whether it is mutual fund distribution, whether it is equity brokerage, and so on, has meant that it is easier and a lot cheaper now to buy a mutual fund or a share simply by clicking a few buttons on your phone, has all contributed to the fact that there is genuine retail participation in equities, and that in India is something that has happened in the last 7 or 8 years, which has been a great development, and this is not a case anymore of a few people giving in to their fear of missing out. So I don't subscribe to the theory that listen, a lot of retail participation, so that is an indication of something that is about to go bad. Now these are markets, so things can change anytime for any
Sure.
number of reasons, which we will all be engaged in punditry over with a 2020 hindsight. But as of today, anyone saying that retail participation is an indication of immaturity of the markets, I would say just the reverse. It's the indication of a maturity of the markets. India is probably one of the few markets in the world where retail participation in equities has been so the growth in the retail participation has been so fast and grown to this extent without mandatory savings kicking into the picture. Now, whether it is the
Right.
US through 401ks, whether it is Australia through the Superan funds, typically retail participation is via directed pension savings. India is one of the very few markets where retail participation has grown via completely discretionary savings, whether it is mutual funds and now direct participation in equities. And that's been a good story, structural story, and that's something that is good because since 91 we have seen a situation where the fate of Indian equity markets was determined by FII flows. So if
Yeah, that's
FII
true.
were high, markets would be making all-time highs, and when FIIs exited, markets would fall usually. But in the last 7 or 8 years, Indian investors have formed the bulwark of flows into the market. So there is a lot less susceptibility to equity market prices because of global flows. Not to say that they're not important anymore, but at the margin, there is a very large domestic investor base that is investing in Indian equities and provides what I sometimes call the SLR for the equity market. Just as banks need to invest about 19% of their deposits into GSEC, so that's the SLR, right? And that provides a sort of floor to bond prices, sovereign bond prices. Similarly, the domestic equity flows provide a certain amount of floor to domestic equity prices as well. So that's structurally actually a very strong positive for India, and I wouldn't take that as anything other than that.
Okay. Final question, Somnath, and that is on themes, right? Yeah, I mean, you guys are really get into the depth. You advise the creme de la creme of India putting in money to work. What themes within India work for you? I mean, we speak to Pratik a
Mhm,
number of times within your group, and he tells us a number of times about what he's thinking. I
mhm,
wonder what are your thoughts, and are there things which are looking promising? Because almost everybody seems to say that innovation is happening in Silicon Valley, maybe in Taiwan, maybe in not Japan really, but that
mhm,
areas and not in India. Are you
mhm.
finding promising themes within India?
Oh, absolutely. There are several promising themes coming up in India. Some of the uh, listen, India is one of the few markets around the world that offers scale for any of these innovation constructs that are coming up, um, especially on the consumer side. Very few markets offer the depth and breadth that India does, and typically innovation typically tends to follow the market. US is obviously a very large market, so is China, but India is certainly the next in terms of offering depth and scale for any of these new innovative ideas to find its feet and prove a concept in. Therefore, a lot of good innovative stuff is happening, none of which are mature enough, or very few of them are mature enough to be hitting the public markets yet. But certainly on the private side, a lot of very interesting stuff happening. We are seeing in the last 6 7 months the kind of investor interest that has come into the education technology area. We have seen the kind of investor interest coming into consumer retail. We have seen an enormous amount of interest from global private investors as well as local domestic HNI investors into fintechs that are trying out new business models in terms of either disintermediating or indeed creating new markets. So a lot of innovations happening, and in the next 5 6 years, expect at least some of them to be hitting the public markets as well. Most of them are in the private markets currently because still early stages, but expect a few of them to be hitting public markets in the next 5 to 6 years. So innovation as a theme, big in India. I don't think that it's a Silicon Valley reserve at all. Not in the least. It is Silicon Valley remains the largest. China remains a very large piece. Israel is another very large hotspot for that. But so is India. So that is there. Secondly, in terms of theme, a couple of areas which are likely to play out uh, would be the entire replacement demand for some of the China imports that we have seen. Make in India initiatives, whether it is in terms of tariff walls, whether it is in terms of non-tariff barriers that are put up that provide that incremental level of protection for Indian manufacturers to start providing a replacement for a ready import demand that is already there. That should, in certain areas, provide new opportunities in the market, certainly in APIs, in pharma APIs, in specialty chemicals, in parts of auto ancillaries. We should see newer companies or even existing companies scaling up to be meeting that demand, and that should be an area to watch out for. I would also keep an eye out for some of the newer experiments or the newer um, e- efforts being made on the financial market side. Um, Financials, of course, have not done as well as some of the other sectors in the recent rally, but remember, this is financial services is the engine for the economy. If we don't have a strong financial services, the economy will only muddle through, and there will always be a binding constraint. Expect a lot more of the non-traditional financial services to be hitting the public markets, whether it is asset management, insurance, wealth management. We have seen in the last few years some of those happening, but expect a lot many more of them to be in the public markets, enabling people to participate. Um, this whole shift of household financial savings from being with to just bring back the illustration we spoke of a little while back, from going to the neighborhood bank to exploring other types of financial products, whether it is mutual funds, whether it is insurance, whether it is portfolio management services, whether it is anything else, alternative investment funds. So companies that are in that intermediation space would more of them would hit the public markets. That is going to be an interesting play in the years to come, because the shift of financial savings from bank deposits to others. Bank deposits, remember, still contribute 50%, half of the total household financial savings in India. That's a very high number by global standards. So those are the few areas that we think we investors should keep their eyes out for, and and not just passively look at existing companies that are listed, that are big, that are quality, and that are doing well today.
Well, maybe over the course of the next few months, Somnath, we'll have more chances to interact, wherein you can guide us into some of these new age developments as well. In fact, a show on what are the newer areas that India Inc. is opening up for public
Sure,
investors would be amazing the next time that we talk.
absolutely, happy to do
But it
that.
was yeah, it was lovely talking today, Somnath. Thank you so much for sparing the time and
Likewise,
talking to us during
Neeraj.
Talking Point.
Yeah, likewise, likewise.
All right.
Good to
Pleasure.
see you.
Pleasure is ours.
Bye.
Likewise.
Bye.
And stay safe. And viewers, thanks for tuning in to this very, very interesting and a different conversation on Talking Point.